Hey everyone, Nick Shaheen here looking at Macy's. Apparently Goldman Sachs downgraded it or somebody there overnight, and it probably reacted negatively, and now it's up on a day where the stock market is down a little bit ahead of the Fed meeting. So maybe it's capitulation for a little bit, some sort of a let's draw in some more buyers before we sell it again. Clearly this is a stock that is suffering long term. This is a weekly chart. Shorted it a long time ago, several times, but I think this was the major time where I went on a rant sometime saying that they're doing all the wrong things, and people kept buying the stock down. So technically, it has played out according to what I would expect. So I have nothing against the company right now, but I think that they're lost. Fundamentally, I could go on for how I would fix it, but it would require complete carve-outs, big carve-outs, I should say. So back to the point at hand. Do I chase it? Do I not chase it? Is this a bottom? Clearly, it has signaled bottoms before, and they're falling out. Arguably, this is a daily chart, so arguably that this is the longest bottom it's set in a while. A hard line, because I can literally draw a hard line. It tried to set a bottom here, but there are peaks and valleys into it. So, I wouldn't short it based on the Goldman Sachs note, but I would need more information. So to me, I would, if I was long it or looking to get trading in it, long or short, I would need to get into more granular mode. So this is an hour chart. So every candle here you see is 1 hour. This would help me find starting points, trigger lines. So if I'm long or looking to get long Macy's, I have two lines to watch. This tick right here and this tick right there. There's a gap into what looks like the earnings. And usually they say gaps want to be filled, but usually when the gaps happen on earnings or into a headline, a fundamental change, that reason needs to get out of the way first. So in my experiences, rallies into the open of the gap, the mouth of it, so to speak, fail unless the reason they fell is kind of gone, or at least hope of it being gone. And in this case, I don't know, so somebody needs to do their homework there. But triggers, 1570 would be a trigger to start a long position because of this one dojish candle there. Indecision, sell, rally, ended up going down. Another similar candle right here. So to be on the safe side, I'm going to do this to bring my attention to it. Whether I trade it or not, I know that there's a trade there. So yeah, I'll miss out a few pennies, but I don't want to grab it here and it fade on me. It's done that before. So I want to see it go above that line before I start hoping that it's going to fill that up. And moreover, when it gets to filling that and it hits this level, that would be an exit point because this is a prior failure level, and I'd rather get out and re-engage above it than to hold the profits and then end up losing them. So, but again, it all depends on the investor intentions. If I believe in Macy's long term, then I shouldn't worry about it picking pennies here and there. I should just own it for the long term. Clearly, it hasn't worked out. By the way, nothing in here is actual trade alert of sorts. This is an alert for me to look at the chart when it gets there. Conversely, if this fails, then it's probably going to get uglier. So I will put another alert here. So this is the somewhat short-term plan on it for somebody who's actively trading. There are more active trades on a shorter period of time. So this is a 15-minute chart. So every candle is 15 minutes. And you can see how this level here where it's falling into, that little dip here, was a roof. So arguably somebody could say, we broke out of it and now they're retesting it for footing. So I really shouldn't panic short-term, really short-term until 15.4. And the dips down to here should be bought. And then the trigger would be here somewhere, not way up there. So for giggles, I'm going to do this. All right, so then, and if it comes down to here, then the advantage that the bulls had on the shorter term is kind of gone. So if you can look at this, it looks like a cup and handle, a couple of them. where there was a big dip where the bulls were losing, and then the bears got them back to a neckline from back here. This was an accident scene. And then the second effort to do so, if it fails for the bears and the bulls were able to come back here and above it, then that looks like a cup and handle, correct? And then the bulls should overwhelm the bears and have their little rally, which will trigger this one, which was probably another pattern. And if you can argue that this is kind of a pattern right here that's unfolding. So all in all, looks like the bulls have the upper hand right now from a short-term trading perspective. But depends on the time frame one is trading at. I'd rather wait to see the breach of this, or preferably this, but all depends on time frame. So this is the line I just added on a 15-minute chart. So clearly it's an active idea there. Some people trade on a 5-minute chart. Then they might find like this trigger level or that. So it all depends on the time frame. If I zoom out, it's an ugly picture. So maybe now I will address my idea to this. Clearly, whatever they're doing, I think they're killing themselves. The migration to quote online is not taking back Amazon foot traffic. It's actually eating, or business. It's actually eating away at the Macy's foot traffic. So, and they say that they're losing money because they're trying to get back. They're trying to grow their online business, but it's at the expense of killing the stores because they're taking away foot traffic. So they're losing money, extra money, in order to kill their own stores. Just doesn't make sense. That's my interpretation. It's not fact, of course, but it's my interpretation of it. People keep saying the dividend is safe, not safe. There's another, potential trigger to the downside. But fundamentally, they need to do something different. What about buying Stitch Fix? Sell a lot of stores. I think they own their own real estate. Get rid of them. Buy Stitch Fix. I know Stitch Fix is like $2 billion market cap. They're about 4.5, 5. I can't remember. So almost 5 Macy's. So get into something that's quote subscription model to where you have a baseline from which you can grow. Make it a niche market. Make your stores a destination thing where celebrities or something. Where make it specific to somebody that wants to be pampered in the store in person, or somebody that just wants subscription service via a Stitch Fix like AI driven, all the buzzwords. You can jam pack them all in there, but that requires changing Macy's altogether, and I don't know if they're committed to that or not. But whatever they're doing now is not working. Look at this. This is hideous. They're back to 2009 levels, after the debacle of 2008 zone, this whole zone. So there needs to be something done at the corporate level. It's a big company. It's a shame to see it dwindle like that, but it's a great trading vehicle here because it's a low dollar stock, not cheap, different. Low dollar stock. Is it cheap? Maybe it is. That people can trade in and out without needing a pile of money to do it. And I think the options markets also provide you. It's a 5 PE. So from that perspective, it's not bloated, and it sells at 0.2 times sales. So clearly, yeah, it can go lower, but if I have to own it for a little bit, it's not going to be a disaster for the short term. I can get out of it with minimal damage, so to speak. All right, Nick signing out.